Good evening, everyone. Time for another silver update. This is the weekly chart of silver provided by netdania.com. You can click on the link below. This is the long-term view, and I've highlighted a couple things here trying to demonstrate here how oversold silver is. Of course, this is paper silver, and as we're going to talk about later, the connect and disconnect between paper silver and physical silver. That's going to be one of the topics we talk about. But nevertheless, this price of paper silver is tied to the physical due to the fact that the coin dealers and the bullion banks and the bullion dealers and all the rest, they link their prices to this. So currently there is a connection between these two prices. There may not be in the future, but there currently is, so it's relevant. Now, I've marked out a couple important points here. This is the oversold point of the 2008 correction. I marked the point where the blue line crossed the zero line on the MACD, and then when the red line crossed positive through the zero line, and that is the period of oversold time frame for that correction. Now, the current correction that we're on, I've done the same thing. I've drawn a line down from where the blue line crossed through, and I've actually projected the red line crossing up. It would actually have to go straight up from here, which is highly unlikely. It's much more likely that we'll do something like this, so the cross will actually be out even farther. But you can see that the size of this oversold condition here that we're under, the time frame of it is actually almost twice as large as the time frame of the oversold condition that we have here. So one could argue that we're already twice as oversold by that measure. The other measure would be the depth of the MACD, and you can see that's pretty much a tie. We've matched the most oversold that we've ever been in recent history, at least in the last 13 years. We're the most oversold we've been, or we reached the most oversold, and we're now starting to rally out of it. This one is unique because we rallied towards the zero line and then failed, and now we're starting to round up. So 2 points that indicate that we have reached the most, or tied for the most oversold condition in recent history in silver. And that's just another reason to expect a rally and to keep stacking. Now, over to the question of the night. This is from OMYG Silver, and it's a free market versus regulated economy. I'm going to try to answer this. There's a lot of questions contained in this. So I'm going to try to answer them as I go through it. Brother John, thank you for all your video updates online. Can you explain how a regulated economy can maintain itself when any free market system operates nearby? Case in point, the price of silver. How can the price of paper silver depress the price of actual physical silver if the amount of physical silver needed is not available? Now, the question you have to ask here is, if the amount of physical silver is not available, for what? Obviously, the amount of physical silver is available for what it is used for in manufacturing. In fact, manufacturing takes up roughly half. Now, is the amount of physical silver needed available for investment? Absolutely not. If the amount of investors who believe they own physical silver actually owned it, there would be a much higher price, because there's just not nearly as much silver as they think there is. A lot of these are allocated, unallocated, but they don't really have any silver. So take gold as an example. Let's say if the amount of physical gold needed is not available, well, how much physical gold is actually needed? How much, let's say, gold that's needed for jewelry? How much is actually needed from what's mined every year? I don't know, but I suspect it's a very small number. So with gold, actually, the vast majority of gold is investment gold. And a lot of that gold is physical, but a lot of that gold is paper. So even in the case of gold, there really isn't enough gold for the investment demand if it were physical gold. Of course, it is spoken for multiple times because it's allocated, unallocated, GLD gold. We don't know. No one really knows how many parties have claim to the same gold. But we know that with silver, the problem is much, much worse because there is very little physical silver available for investment demand, but there's a lot of physical gold. Continuing, if true, physical silver was in short supply, dealers would need to adjust the premium of their product over that of the cost of raw material or spot price. One would expect to see a surcharge for delivery needed to balance the supply and demand equation. Now, this is applying the point to just the coins and the bullion. As I said, the vast majority of investors in silver don't actually invest in physical silver. They're investing in paper, Ponzi schemes that claim to have physical silver, but in my opinion, don't have any. Continuing, do the silver dealers simply cut out the middleman and deal with the mines directly? Well, I've already answered that. Yes, in fact, they do. The COMEX only delivers 5% of the physical silver that's actually used in manufacturing. The other 95% of silver actually is delivered directly from the mines. So the COMEX is much more of a paper trading system than it is a system of delivery of a physical commodity, at least for silver. Do they make up the lack of production from the mines by recycling used inventories? Yes, recycling is a factor, but there's only so much that can be recycled. I think it's 1 to 200 million ounces a year now. Somehow the demand for the product needs to balance with the value of production. Is it simply a demand principle that the idea that people will not pay $2 for a piece of silver that has a 10-cent price tag stamped on its face, or is it the need to hold up profits in other sections of the economies, make it plausible to allow such a huge loss in this sector? Well, there is a huge loss in the sector. You can go and check the recent price of Pan American Silver. You can check the prices of a lot of the silver miners, and it's my contention that they are actually, for all intents and purposes, operating at a loss, and that's because the price of silver is not keeping up with the price of the cost inputs of mining it. So yes, that industry is suffering, and of course the Silver Users Association is one of the groups that's behind promoting the suppression of the price of silver, even though they won't publicly admit that. But these silver users want to get very cheap silver, and yes, they are causing losses to the silver producers because the prices are being held so low. Continuing, here's the bind. Numismatic stackers purchase the limited editions while junk silver collectors hoard the worn, I think it's supposed to be WORN, coins previously doomed to recycle fires. Labor costs increase as miners dig deeper to find new veins. Older, less productive closed mines have not been reopened. The cost of refining goes up with the cost of labor and energy needed in the production of silver. How can paper silver suppress the price of physical silver if there is in fact a true shortage of the metal? As far as I can understand, they cannot both exist unless they're a true reality with each other. So what are they? Separate but different, or separate and the same? Well, again, there is not a true shortage of silver as far as a shortage in how much silver is mined every year that is needed for manufacturing. Roughly twice as much silver is mined as is needed for manufacturing. But if you add in the investment demand, the physical investment demand, that takes up another couple 100 million ounces of silver. Now, if you're talking about the investment demand that's paper investment demand, those people believe they have silver, but I don't believe they do. And the BIS has cited as much as $200 billion in other metals, which presumably would be silver. So my contention is that probably 95 to 99% of the people who think they own silver really own just a piece of paper. And in that case, there actually is a true shortage in investment silver. But the reason why that shortage is not apparent is because the people are still willing to take paper for silver. If all the people who thought they owned silver demanded delivery, or if all the people who thought they wanted to buy silver demanded physical silver or bullion coins, then yes, you would find a true shortage and this thing would break loose. So I hope that answers the question. Actually, there's a lot of questions there. I hope that clears up some of those questions. Now, I wanted to take a look at the chart of the Chinese stock market because there have been a lot of articles lately. These articles and news stories come out every 6 months or so. I call them the China bashers. They are the people who say that China is going to crash. China is not going to crash. There's a lot of reasons why China is not going to crash. This is one of them. You can see this is the Chinese Composite Index. This is the SSEC, I believe it is, and the Shanghai Composite. And this index, you can see by looking at it that the top that it reached in 2001, 2002 was approximately 2000. It's exactly the price that we're at. So for all intents and purposes, this index has gone nowhere for the last decade. Now, on the other hand, the growth in China has been tremendous over the last decade. So this stock market does not reflect the growth in China. And ultimately, I believe it will. If you look at interview in Market Wizards with Jimmy Rogers when he was buying the German stock market back in the 80s, or other stock markets, it's very common for a stock market to follow industrial growth. So industrial growth can occur for 1, 2, or even 3 decades, and then finally the paper markets will catch up with the growth that's there and the shares will explode in price. So clearly here there's not an overvalued stock market in China. It's my contention as well that there isn't an overvalued real estate market in China. And the reason why is because, one, Chinese interest rates are still quite high, around 6%. Two, China, most of the real estate buyers in China are putting up a substantial portion of the amount of the loan, in some cases as high as 40% of the amount the cost of the property is put up as a deposit or collateral. So that's not something that you saw in the U.S. real estate bubble. They got to the point where they were literally loaning people money with absolutely nothing down because they were actually loaning them the down payment as well. So, and I could give you a number of other measures from trading economics, but I've done that in the past. So I just wanted to mention here that we've had another China basher scare, and of course this one's going to fail and go away just like all the rest of them have over the last 5 years that I've been following this, because China is nowhere in the situation that the United States is in. The United States is the 800 gazillion ton elephant sitting in the room, and we'll look at that when we talk about JP Morgan. But basically, again, it's anything for the U.S. press to distract, whether it means pointing to Europe or pointing to China, but to distract people from the 8 gazillion ton elephant in the room, and that is the collapse of the dollar and the petrodollar system in the U.S. economy, which is coming very quickly. Now, I wanted to take you over to the blog, and again, I wanted to thank everybody who's donated from PayPal. Even the smallest amount helps. We do have quite a bit of costs, and then the Bitcoins as well. And I wanted to show you a new sponsor that I have. This is actually a product that I purchased about 4 years ago. It's called LifeStraw, and it links over to Earth Easy. I actually bought this product while I was doing some prepping, found out about it about 4 years ago. The people who created this were actually trying to solve the contaminated water problem in Africa. And they were proposing that this be sold for $5. That was the original intention. I think it's a Northern European company, Vestergaard, I think is the name of them. But they had this idea of providing these straws that basically filter out all the contaminants. You can actually drink. I was amazed when I studied this, find out you can actually drink from the ocean with this. It'll cut down the life of it. It's a very complex series of tubes and filters. It has a 1-year lifespan for the normal drinking of one person out of any water source. If you drink out of the ocean, it cuts the lifespan in half. So you've got about 6 months lifespan for one person drinking out of the ocean. But if you can imagine how invaluable that would be, how many people have died of thirst being stranded on the ocean. So if I were ever to go out on the ocean for a long trip, I would definitely take one or two of these with me. There are a lot of hikers who use them. So it's really an incredible product. I just can't say enough about it. I bought mine. I actually had to import them from England a number of years ago because they weren't available in the United States. But it is available in the United States right now, and that's why I'm putting them on as a sponsor. I have some of these. I'll probably be getting more. But it's just one of those things that is such a neat invention. And I was just so blown away by the idea that you can drink from the ocean for 6 months with this $20 straw. So if you're interested, go ahead and click on that. They're really neat. And the last story is the big story of the night, and that's broken on Zero Hedge. Apparently this broke on Reuters just a few hours ago. And as I was pointing out, the 8 gazillion-ton elephant in the room is the U.S. dollar and the U.S. Treasury market and the U.S. economy and the U.S. deficit and the U.S. petrodollar. And again, J.P. Morgan and Jamie Dimon are right in the heart of this thing. And the biggest player in the derivatives market is, of course, J.P. Morgan. And the biggest manipulator of the silver price is, of course, J.P. Morgan. And it's my contention that when J.P. Morgan finally does blow up, it's probably going to be the end of a lot of this stuff. So the latest, I'll just read the last paragraph here that Tyler states. Here's the problem. Nobody will be stupid enough to believe for 1 second that the marks on hundreds of billions in securities passed from the front office straight to JP Morgan's 10Q without vetting by middle office, back office, treasury office, and even in some cases counterparties. In other words, if JP Morgan is indeed stupid enough to attempt to pull a Fabrice Touré on CIO, it won't work. Actually, scratch that. It may work, but it will involve a fine, i.e. a bribe, of about $1 billion to the SEC and countless promises of perpetual campaign donations to all the other corrupt members of Congress and the Senate, which, if this fraud flies by unscathed, will mean all of them. Ironically, if only J.P. Morgan had indeed been honest and told the public that not only did it have a loss, but it had discovered, quote, material lapses in internal control back on May 10th when the story hit, it would be a non-event by now. Instead, with the phased-in revelations of events that even the most inexperienced trader knows full well all took place at the same time, it is becoming very obvious that Jamie Dimon and crew are merely hiding more and more revelations in some dark corner. And what is the scariest is that all this excludes the liability that the bank will with absolute certainty have as a result of LIBORgate, and that is one of the only 3 U.S. members of the U.S. dollar LIBOR fixing committee at the British Banksters Association. We will leave with the final words to our good friend from Bloomberg, Jonathan Weil, who said, quote, "It was once inconceivable that Dimon might someday wind up like Barclays CEO Bob Diamond, who resigned last week after that company's LIBOR scandal broke wide open. It's not anymore. It certainly is not." So it does appear that JP Morgan and Jamie Dimon, as I've been saying for the last couple of weeks, someone is out to get them. Who that someone is, I don't know. I don't know who the powers that be are and how many factions of those powers there are. It does seem that every time Bix Weir's story seems to be discredited or doubtful, then more of this stuff happens. Clearly, it has to be a faction that's very powerful if this faction is going to take down Jamie Dimon and JP Morgan and probably the Treasury and the Federal Reserve if that happens. So Very big news story. It seems to be percolating. Where there's smoke, there's fire. And it seems that the fire is starting to burn a little bit stronger. There's quite a bit more smoke coming out of it. And I think that it's going to end in a derivatives nightmare, a derivatives blow up, and of course, an expose as well on the silver suppression, probably taking JP Morgan out of the silver suppression game. And at that point, since they're kind of the last man standing to inherit the shorts that came through Bear Stearns and then to JP Morgan, who's going to take those on if JP Morgan is finished? That may be the death knell of the silver manipulation, but we'll just have to wait and see. And we'll talk to you next time.